Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, it's a little bit after the hour. Good morning, everyone. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Alan Clopine. He's a CPA. Thanks for tuning in over the next couple of hours. Happy Labor Day weekend.
Yes, sir.
I always get Labor Day and Memorial Day.
I know. I think a lot of us do. But yeah, this is Labor Day weekend.
So all us laborers.
Yes, we're celebrating their hard effort because
we can relax.
I mean, we can relax because let's face it. I mean, it's the labors of us and those that came before us that made America great, right? And you stand up when it's Star Spangled Banner, right? And
I do.
Put your hand across your heart.
Yes,
Take
sir.
off your hat.
Yep.
Me too. Nothing wrong with that.
Well, you want to get into some Kaepernick talk? Is that
not really.
Is that where you were going with that?
I was, but
Oh, I don't even want to go there.
I don't quite get that. But I guess everyone has a right to do it their own expression, right?
I suppose. This is a financial planning show, and we're going to get into financial planning topics. IRAs, 401ks, taxes, investments, Social Security, whatever. We got a bunch of email questions we'll get through again today. A couple of other things. We got Larry Swedrow, our good friend Larry. He'll be joining us momentarily. If you have not listened to Larry, he's been on our show now for...
He's been kind of a semi-regular for the last 2-3 years, I would say.
Probably longer than that, it seems like.
Maybe.
And but he wrote a new book.
Yes.
I think this is number 14 or 15.
I think so, too.
And I think a couple books ago he said he was done.
Yeah, I remember that. And then 2 more have come out since then.
Yeah. So we'll talk to Larry about his new book, Factor Investing.
Yes.
That's going to be riveting.
Yes. Well, and I'll give you a little prelude. Factors include something like a small company tends to outperform a large company. So if you tilt your portfolio towards small companies, you do a little bit better. That's what a factor is.
Sure. And then there's a lot more strategies coming out when it comes to factor investing. They call it smart beta.
Yeah, right.
And our firm, we do factor investing.
Yes, we do.
We tilt our portfolios towards value companies, small company, profitable companies.
Yeah, and that's kind of one of the newer ones, right? Profitable companies.
Well, there's hundreds of them now.
Yes, I understand.
Right?
But I mean, if you the main ones people talk about is stocks versus bonds. They talk about value companies versus growth, small companies versus small versus large, and then now profitable companies tend to outperform less profitable companies, which actually kind of seems intuitive.
Yeah, and I talked to Larry about this, a few months ago, and when he was on the air, and he's not sure if that factor is going to hold.
Yeah.
Because there's not a true risk story.
Yeah, this does seem a little bit contrary to most factors,
right?
Where risk and return are related.
Exactly.
Because you would think more profitable companies would be less
risky.
Yeah.
And so with less risky means lower expected returns.
Yeah. So I agree. We'll see how this all plays out.
So we'll talk to Larry. Go to our website if you'd like, purefinancial.com. Tuesday, I'm doing a webinar on long-term care. It's short and sweet. It's about a half an hour long. Just kind of the basics of what you need to do, what you need to know. So if you want to go to our website at purefinancial.com, you can get a recording of that as well. We're taping live Tuesday. We're doing it live on Tuesday, but of course we're going to record it. All you got to do is sign up for it, and then you can get the recording. So purefinancial.com, go in our learning center. There's 400 videos there. Multiple different webinars and things of that nature. So,
Joe, I think when we talk about long-term care planning, a lot of people assume we mean you have to buy insurance, and that's one way to solve an issue, but not the only way.
Right. I mean, you can self-insure.
Sure.
Right, and then so you're just paying it out of pocket.
Right.
Or just have a plan.
Yeah.
And so it's going to be a combination of a couple of different things potentially. Maybe you just want to insure a portion of it. You're going to use your assets for another portion.
Yeah, and maybe you got Social Security and pension that covers a portion of it. I mean, that's what this is all about, is making sure that you are covered in case you got to go to a long-term care facility.
Sure, and I think when it comes to long-term care, too, it's not necessarily you're planning because if I have Alzheimer's or dementia, you know what I mean? I don't know. I'm not going to remember I'm in a home.
Right.
Right. But my spouse that has, who's still very healthy
Yes.
is going to remember it.
Right.
And then I'm going to drain all the assets from the household.
Right.
And going to leave her destitute. And, so you got to be careful when you look at this type of planning. It's like, okay, well, here, no, I'm going to be healthy, or I'm going to just, call my brother and he'll take care of it.
Yeah, I'm going to go to Oregon and take some pill, and then I'm done.
Right. Yeah, exactly. So I think a lot of people say that just because they don't necessarily want to think about the realities
I think that's
of it,
exactly right.
And so it's just making sure that you have a plan in place for it, just a contingency plan. 70% of us over the age 65 will need some sort of care. And it's not necessarily illness. It's accidents is on the rise.
Yeah,
because we're living a lot longer, right?
Yeah.
And our bodies are getting more frail. So, right, you fall, you break your hip, you break your leg.
Yes.
And it takes a lot longer to recuperate. Right?
And that doesn't necessarily mean you go to a facility. It could be in-home care.
In-home, yeah, home health care.
But that's a valid statistic, which means the majority of us need to have some kind of long-term care plan, I guess, and so we need to have a plan for it. Because another surprising thing is Medicare doesn't necessarily cover that.
Yeah, Medicare will cover the first 20 days. They cover skilled care, right? They don't necessarily cover custodial care.
Right.
So custodial care means you're not necessarily going to get better. Skilled care is that they can kind of patch you up, fix you up, get you out the door.
Broken leg type of thing, or whatever.
Right.
Yeah.
And so with the rehabs and PT and all that would then go into a facility where then you would need some sort of long-term care potentially to cover that. So well, we cover soup. Thank you for that. Yeah. She can hear me sniffling, I guess.
She's brought in a roll of toilet paper.
Yeah.
Wow, that's a big one. You going to go through that whole thing?
Oh, sure. What the heck? Yeah. I don't know what the heck.
Got a little head coat.
I don't know what the heck it is. It's summer,
Yeah,
it's Memorial Day weekend.
Labor Day
weekend.
Yeah.
Right? I don't need this stuff.
No. You're supposed to get colds in the winter.
I know, right? And I'm from Minnesota.
Yeah.
It's like it's 80 degrees.
It's been so cold here lately.
Yeah. So I don't know. Anyway, we got your email questions. We have some facts and figures. Al's got a bunch of great articles that he's probably going to share with us. What's your top 3 that you want to get
articles?
Into? Yeah, do you have anything?
I got the 13 biggest financial fears from Americans. You don't want to miss that one.
13?
Yeah. And then I got Warren Buffett just turned 86 this past week, and guess how much money he made for every day of his life?
A couple $1 million.
That's correct. If you take his current wealth and divide it by the number of days that he's been alive, he's averaged making $2 million per day, every single day.
So he's 86 years old?
Yes. And he's still a CEO of Berkshire Hathaway. He's the oldest CEO of an S&P 500 company.
So I wonder what people are going to do when he passes.
Yeah, it's a good question. Well, suppose what he's saying is that he's developed a whole bunch of protégés in Berkshire Hathaway that'll take over with his philosophies.
Yeah, but we haven't heard of them.
I know, right? So I don't know.
You know what I mean?
Right, and he's been reluctant to say who his successor is going to be.
And I mean, his buddy Charlie Munger. Have you seen him?
No, he's old.
He's older.
Yeah.
Woo!
Yeah.
Jeez.
He's not taking over.
So, anyway, so we got. I guess for this Labor Day weekend, we'll labor through this and get you really good information. If you have any questions, you can always go to purefinancial.com. Info@purefinancial is our email. And I'm going to dive into the emails when we get back from the break, Al.
Okay, good.
Because I got a few here from Investopedia. We got some NerdWallet ones. And I like actually going through those.
Yeah, they are kind of fun, at least for us. I think our listeners like it. I mean, we hear positive feedback.
And sometimes negative.
And sometimes, yeah.
Yeah, one of my favorite clients was in last week.
Yes.
She was referring a friend of hers. She's like, yo, you have to listen to these 2 young chaps on the radio.
I like being called young.
And so next thing, and she's like, well, were you guys drunk? I was like, drunk?
You were laughing?
What are you talking about?
These are serious questions.
Yes, it's finance.
Yeah.
You can't be laughing and joking around.
It's not allowed.
It's on, yeah. I was like, no, I wasn't drunk yet. After the show, maybe.
Maybe.
But I wasn't on air.
Not before.
Not before.
We just have a good time with it.
Yeah.
There's nothing wrong with that, is there?
I don't think so. We've been doing this 10 years. We got to make,
Gotta have some
talking
fun
about
with
the
it.
same thing every weekend. All right, we got to take a break. Don't go anywhere. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson, Big Al, hanging out. Thanks for tuning in. Talking financial planning, investments, whatever. Investopedia sends me emails. Full disclosure, they did send me a pair of colorful socks, so I did get some sort of compensation, Alan.
Well, you're being you're transparent, aren't you?
I am very transparent.
I like it.
And so what they send me these things, and they're like, hey, you know what? We need help. Here's some questions from individuals that go to Investopedia.
Yeah, some are pretty good.
Yeah,
I remember.
and then some people write these emails. It's like, I'm surprised you had a computer.
Yeah.
They're off the charts. And
Yes.
so we go in black here, dark.
Dark. I
We don't
know
read them
what questions
before
are.
we go on the air, just to
Yeah,
make it a little bit more interesting.
Neither you nor I have seen these.
So, a couple of tax ones here for you, Al.
Oh, perfect.
Do I need to pay capital gains tax on the sale of my retail space? All right.
Oh, we did that one last week.
Did we?
Yeah.
No, I don't think so.
I think we did.
Really? I am being bought out by my second business? Oh, yeah, we did do that
We
one
did.
last one. Okay, well, here's the next one. I got plenty here.
God, you got last week's pile?
We didn't finish them.
Oh, okay.
We didn't finish them. All right, what type of loan should I use to buy out my sibling for inherited property?
What type of loan?
Yeah, come on, that's new. That's hot off the press.
That is hot. We haven't had that question.
Is there
Okay.
a certain type of loan I need to ask for? So she's trying to buy out her siblings on a property.
Okay, so in other words, she inherited a property along with her sibling or siblings, and she wants to buy them out.
She's
sounds
like, so she was probably living in the house.
Probably, I would expect.
Right?
Yeah.
Have you ever seen that?
Yes, very common.
You know, hey, I'm still living at home.
Yep.
I'm 65.
and I want to stay here.
Hey, this is my house. No, it's not. It's mom and dad's house.
Yeah, we're
You've
splitting
just
it
been
6 ways.
freeloading for 60 years on mom and dad. Well, I want to buy you out.
Yeah.
So now she's asking Big Al, how do I get a loan?
do that? Okay, well, that's relatively simple. So take the value of the home. So I'm just going to make up a number, $500,000. That's what it's worth. And let's say, did it say sibling or siblings?
Buy out my sibling.
Sibling. Okay,
Yeah.
2 siblings. So in other words, each of them, and let's just pretend there's no mortgage. So $250,000 of equity each. So she inherits $250,000, and then she's got to pay her sibling $250,000, right? And so the way that is done, typically you would set up a mortgage loan. So your sibling then would be like the bank, if you will, and you could set up a 15-year loan or a 30-year loan, just like a bank would do.
Why wouldn't you just go to a bank?
Could. I'm assuming that she doesn't have the money or
because she's a
creditability.
freeloader is what
Yes.
you're
Well,
assuming.
Going off of your story.
Got it.
I'll come back to the other one. So if you want to do it my way in terms of paying the sibling, then you're just going to pay him a monthly payment, just like a bank, right?
But what sibling would go for that?
Well,
So you and I are brothers.
Yeah.
I've been living in the house.
well, if I
and
could-
you're like, hey, you got to buy me out.
If you paid
and I'll
me-
be like, okay, well, can I just pay you monthly? $500 a month?
I'll say, well, we'll do a 9% interest rate, sure.
All right.
Yeah,
Can you do that?
yeah,
Well, I suppose you can assess my risk
Sure.
level.
sure. And which I would be pretty high.
Yeah, whatever.
So yeah, you could do that, or better yet, for the other sibling, of course, is for the sibling that has the home. They go to the bank, they get they borrow $250,000, they pay it to the other sibling, and now they pay the bank. That's actually the best way to do it, but not all people can afford a loan.
So, but let's say that I have decent credit, decent income. I
Yeah.
go to the bank and I say, hey, I have this house.
Yes.
I inherited it.
Yeah.
Now here's the title. It's my brother and I that
Yeah.
inherit this house.
Right.
So I go through the normal channels of just getting a normal mortgage, front end mortgage, and say I need $250,000.
Yeah.
The mortgage is in my name. They cut me a check, and I just give that check to my brother.
That's exactly right.
And then
Yeah.
from there,
And if-
then it's
And in some cases, if the bank may force you through the escrow to send the money right to the brother, right, and which is okay, same.
right.
Yeah. So then the sibling let's call it the brother. The brother gets paid off, and the sister gets to live in the home and has a $250,000 mortgage on a $500,000 property. But like I said, if you don't have that ability, then you'll have to set up some sort of arrangement with your sibling and some kind of financing, and maybe you'll pay it off later when you can qualify for a loan and you refinance at that point.
This is where a lot of turmoil comes into play.
No kidding, right?
You know what I mean?
Yes.
Some sibling, let's just sell the house. Let's just sell the property.
Yeah, then I get
because I want to get paid.
Right.
Hey, right, you've lived there, or maybe you want to live there, but you don't have the means
to get a loan.
To get a loan and things like that. No, I'm stuck. No, I'm going to be the bad guy.
I don't want to be paid over 30 years.
Right, exactly.
I want my money. I want it.
I want it now because I want
to go buy a home myself.
Sure, or I got kids I got to put through school.
Right.
Right. So one sibling has their own set of goals, and the other sibling has their own set of goals, right?
Yes.
And then now you have this property. And it's like, well, here, I'm going to live in it.
Right.
Fortunately, you can't live in stocks, right?
Right.
So that's easy. That's just an easy split, and then you have your own liquidity and everything else.
So I guess the point here is if you're a parent or if you're older and you're in this situation, make sure you've thought it through. In this particular case, maybe the parents could have had a little bit of life insurance that would give some liquidity so that the daughter living in the home could pay off the other.
Or, I mean, at least express wishes and saying, okay, we'll have a family meeting in a sense.
Right.
Right. Hey, here's what we're looking at here. And then if one sibling, says, you know what, I really want to have the house.
Yes.
I really want to make sure that the house stays in the family. And then the other sibling says, okay, well, how are we going to do this?
Right.
Right.
And then you kind of talk about it as a family.
Yes.
That actually is
while mom and dad are still alive.
Yeah, that's the best answer. It's hard though for families sometimes to talk about money like that and for parents to talk about their own demise.
Sure. But I think what we've done with our firm is that we're having a lot more conversations about, all right, well, here, what's going to happen? Let's have a list of things, because when someone dies, you got passwords, you have, safety deposit boxes that maybe no one really knows. And
right.
So spending the time up front, and I get it, no one really wants to talk about them when they're passed, but it's important.
It is.
Well, it's a couple of hours.
Right. It is, and I think that's exactly right. You may have a will or a trust, and that will spell how the assets are supposed to be divvied up. But a letter of instructions and a meeting beforehand goes a long way.
Right. In saying, all right, well, here, if Johnny really wants the house, okay, well, this is what the house is worth. Or maybe Johnny was a caretaker. Right. So we just talked a little bit about long-term care.
Sure.
So maybe he's been taking care of mom and dad.
Right.
Well, there's definitely some value behind that, monetary value.
And maybe you kind of slant the inheritance towards,
right. And
towards
saying,
the
okay,
caregiver.
well, here, Johnny's staying at home. He's taking care of us. He's our caretaker. He's running out, doing the errands, making sure the house is upkept and everything else. Well, he's going to be compensated for that, and that compensation is this. And so all the siblings know.
Right.
Or else, Billy could say no. And then I want to do, all right, well then, okay, you be the caretaker.
Yeah, all right, you come in and do it too.
Right.
Yeah, no, I don't want to. Well,
no.
Then, okay, then you can't say no.
Yeah. Right. So, I think it's just those open, honest, hard, very difficult discussions.
Yes.
But it will, because we've seen this, Alan. We've been doing this a long time where all of a sudden you have this nice family.
Right.
When mom and dad die, and all of a sudden the siblings are just at each other.
Falls apart.
Right, and it falls apart, and they won't talk for the rest of their lives.
Correct.
Over money. It's so...
And sometimes that happens, Joe, just because the parents don't necessarily trust a couple of the kids, and so then they put the older or whatever, the responsible son or daughter as the trustee, and now you got an adversarial relationship with that sibling versus the other one, and that's not good either.
Right. But then you can't name, let's say you have 3 siblings, you can't necessarily name all 3 as
Yeah,
because then they'll fight.
Right, they'll fight, and they'll probably live in different parts of the country, and they can't get anything done paperwork-wise, and it's logistically a nightmare.
By having that, but mom and dad need to be there, right? It can't be too late where it's like, okay, well, here, dad passed and mom's in the hospital. You have to make sure that you have a plan. And this is estate planning, but it also has to revolve around retirement planning, risk management, and everything else in between. If you had a game plan that covered all of these different questions from A to Z, that would bring so much more confidence in you, the family. It would stop fights and everything else in between.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, Big Al Clopine next to me. Thanks for tuning in. Going through some email questions, and these emails are not directly sent to us. They are sent to a company or website called Investopedia, and then Investopedia sends them to me. They're anonymous. I don't know who they are.
Okay. Yes.
So it's not like, and sometimes we might
And Investopedia decides, of all the people in the country, let's give it to Joe Anderson.
Yes,
Yeah.
pretty much.
That puts you right at the top.
Well, there's other advisors that they answer the questions, but my answers are that much better.
Apparently.
Because
we keep getting them every week, don't we?
Right, because I'm probably the only one that answers them.
Probably.
Here's another one. Which income option is best for a 70-year-old?
Okay.
All right.
Yeah?
I think we did this one too.
Okay.
All right.
Never mind.
Can I avoid paying gift tax? How about this one for a header?
I like it. Okay.
All right. So, can a grandparent gift a grandchild money for college and not have to pay a gift tax? Would the grandchild have to pay taxes on it too?
Good question. Grandparent wants to pay college and wants to avoid gift taxes. And first of all, gift taxes, Joe, is you're allowed to give $14,000 to any individual each year. And if it's grandma and grandpa, they can each give $14,000 to grandson, granddaughter. So that's $28,000. That's if they give them the money. Interestingly enough, if the grandparents pay the college tuition directly, I believe that avoids the gift tax issue.
Well, they can go. They can give up to 5 years of gifts if they go into a 529 plan.
Yeah, well, that's a good point. I'll come back to that.
Or if they just want to gift annually.
Yeah.
Right. So they can give to the right. Both of them can give.
Yes.
28 grand.
28,000, which may cover it. But I believe if the grandparents pay the tuition directly, that doesn't count as a gift. I know for sure if the parents do. Well, yeah, no, it is the grandparents. I take that back. So that can avoid the whole gift tax issue. And then,
but you can give up to $5 million without a gift tax. It's just going to reduce your tax your exclusion.
Yeah.
So if they want to give the grandkid $1 million, depending on the grandparents' net worth, I would say most people, they can give as much as they want. It's really not going to affect anything.
Well, yes, unless they have a big estate.
Sure.
So let's talk about that. So each person gets, under current law, almost $5.5 million exempt when they pass away. So a couple gets about $11 million exempt. Roughly. It's a little bit less than that. So to go to the next generation, tax-free. If you're over that, it's a 40% tax on everything over that. So here's what happens with this $14,000 gift that you can make. If you give more than the $14,000, now that's what they call a taxable gift. It doesn't mean you currently pay taxes on it. It means that gift essentially gets subtracted from your exclusion. And it's
for instance, let's say it's $5.5 million.
Right.
I give grandson $15,000 instead of the $14,000.
Yes.
So $1,000 over the annual exclusion because $14,000 doesn't count. The
That's
other
right.
$1,000 on top of that. So that would reduce the $5.5 million by $1,000.
That's
if
correct.
I pass away.
That's right. And it's for you accountants out there. It's a little more complicated than that because they use what's called a unified credit rule, but it's easier to visualize that way. In essence, if you give more than the $14,000 today, you have to file a gift tax return and you'll get less benefit or less exclusion when you actually do pass away. So you could give $1 million, Joe,
sure.
And then it's like you have roughly a $4.5 million exclusion when you pass away.
So then you look at, all right, well, am I a high net worth individual or just average or low net worth?
Yeah,
right?
for most people, this doesn't even apply.
It doesn't even apply.
Right.
But they hear, all right, well, here I can only give $14,000 away.
Right.
Or I can only give $14,000 to, let's say, a grandchild or son or whatever.
Yeah.
But if I give, they think they have to pay the tax.
Yeah. And
any dollar over that amount. So they're like, okay, now what do I do? How do I file this on my tax return? How much tax am I going to owe?
Yeah, and the truth is you do have to file a return, but you don't have to pay any tax. It just comes off of your future exclusion when you pass away.
Right. And that exclusion is fairly large.
Yes, almost $5.5 million.
So then the other question is all right, well, does the grandchild have to pay tax? Well, it depends on what you give, right? So if you give cash, then no. But let's say if you give Johnny a highly appreciated asset. So let's say you bought it for $1,000, it's worth $14,000 today.
Right.
Well, then the giftor or the giftee keeps the giftor's basis.
Correct.
So what that means is that I'm going to give out $14,000, but the $14,000 is not going to come from cash. It's going to be from a mutual fund that I had that I bought for $1,000. Now it's worth $14,000. I'll just give that to Alan.
Wow, that was a great investment.
Yeah, it was. It's been invested for 40 years.
Got it.
So with that, if Alan when he sells that asset, then that would be a taxable gain on Alan's tax return, whatever growth that is.
Right. So in other words, when you make a gift, your tax basis follows the gift, and whoever then gets the gift and sells the asset will pay the same capital gains that you would have paid had you sold it.
But if you're giving it to a grandchild, the likelihood, and if they're going to college,
right,
or maybe they're in high school, Well, there's this special capital gains tax that you don't pay any capital gains on a capital asset if you're in the 0 or if you're in the 10 or 15% tax bracket.
That is correct. And for a single taxpayer, that's taxable income of about $37,000 or so.
40.
Yeah, close to 40, right? So that's true. Now, if you give a gift to a child that's under 17, you have the kiddie tax rules, and that's a whole nother set of things you got to watch out for. But particularly for a college-age kid, and here's something else for you business owners. How about this? Instead of you paying the college tuition yourself and basically getting no deduction because your adjusted gross income is too high, why don't you put the kid on the payroll and have the kid pay for the college through their payroll, right? And then you got a tax deduction for doing it that way. Now, they actually have to do something for your business. You can't just make it up. But that's a great strategy if you're a business owner.
I was on this national syndicated radio show.
Okay.
Right? And I forget where it was out of. Massachusetts. I think it was like the Harvard Review, something like that. Right?
Okay. You were on it?
Yeah.
Wow.
And it was like, I don't know, a 15-minute segment. And
Okay.
so we would get calls.
Okay.
And they asked me to be on it. So, we'd get calls coming
Sure.
in.
Yeah.
And wow, the host, ultra boring conservative. Right?
Okay.
And I'm like, yeah, are you sure you want me on this show?
I'm going to liven it up.
So a call comes in, right? And he's like, yeah, I'm looking to fund, I want to help my kids out with retirement and this and that and so on and so forth and so whatever, small business owner. And so the host kind of answers some boring, well, I don't know, there's probably not much you can do. And I was like, well, wait a minute, how old are your kids? Like 13, 12. I go put them on the payroll. And then all of a sudden the host was, oh, hey, what do you mean? That's pretty aggressive. I was like, no, it's not. Pay your kids. Have them come in on Saturdays, sweep, clean, right? File.
Right.
Right? Have them work. Right, in your business.
They could probably set up your social network.
Right. Yes, exactly. Be your IT specialist. Get them on the payroll, pay them. Well, they'll have to pay payroll tax. They get a deduction. Now the kids have earned income. Guess what you do with that earned income? Fund a Roth IRA. Right? Because you can't just, let's say, all right, well, here, Junior, I'm going to give you $5,500 to put into a Roth IRA. No, the kid has to have earned income.
Right.
And if they don't have $5,500 of earned income, well, then they can't fund any retirement. Well, they can, but it depends on what their earned income is. If they have $1,000 of earned income, then they can fund $1,000. So it's like, all right, well, you put the kids on the payroll, right? Let them, but make sure they work. I think kids need to work, right? My first job, I was... What was I doing? Washing dishes at a bar on Saturday mornings before the bar opened. It was
Right.
like a bar restaurant
Got
down
it.
the street from my house.
Yeah.
Right?
Yeah. It's
Mopping floors, cleaning. I was probably, 7th grade.
It's interesting, Joe, because there are a lot of people out there. So you're talking about this host on this show, ultra conservative, and there's a lot of accountants that are ultra conservative, and I have no problem with being conservative. But I also think it's really important to take advantage of the tax laws that are given to us. And that's one of them, which is you're a business owner and you can pay your son or daughter to do something in your business and it becomes a deduction for you. You have a higher tax bracket. They have a lower tax bracket. They could use it for college. They could set up a Roth IRA, any number of things. And it's confusing to me why there's so little of this information out there, because if you really understand what the rules and opportunities are, you can take some control over your taxes. But I'll tell you, not many folks are talking about it. And what it boils down to is it's not necessarily their expertise. A lot of investment advisors focus on investments. A lot of accountants focus on year-by-year tax returns. But there's a way to do it, and that's by having a forward-looking tax-efficient strategy. Whether you're saving for retirement or whether you have a business or you're a real estate owner, there's all kinds of things you can do.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Alan Clopine. He's a CPA. Happy Labor Day weekend, everyone. Hopefully you're enjoying some time with friends and family this weekend, unwinding, relaxing. Can't believe this. I guess officially the summer is over. But here in Southern California, it's basically summer every day.
True.
So enjoy the weekend, 3 days. And then the fall comes around. Kids are already back to school. Most kids are back to school now, aren't they?
Yeah, they are. In our neighborhood in Carmel Valley in San Diego, yes, they're back in school. They started, I think it was last week, actually. In fact, a couple weeks ago, maybe.
So, Anyway, we're going into kind of the email bag today. Just there's a lot of different companies now that you could go to. NerdWallet is one of them. Investopedia is one of them. And so if you have questions, or you can always go to just directly to us. Al and I get many email questions, and we answer those.
Yeah, we answer them directly. You want to talk to the two of us? Go for it.
Yeah. Interesting questions that come through.
Very, yes.
And so, yeah, you can always just email us directly. You can go to these other sites, Investopedia, NerdWallet. We have no affiliation. Oh, I did get a pair of socks from Investopedia.
Well, that's not affiliation. That's a compensation.
I did get compensated. Answering 100 questions, I get a pair of socks.
I answer questions. I haven't got anything.
Well, I don't know, Al. I don't think they like your answers.
Apparently.
I don't think they like your answers at all.
Because I'm still wearing just like regular socks. You got these colored socks and everything?
Yeah, they're nice.
Yeah.
Yeah. Okay. Well, I got a couple of...
couple more?
Yeah.
All right, let's see what you got.
This is from NerdWallet.
Okay.
Let's see here. Top questions. I recently opened an LLC and landed my first client.
Good, like it.
Is there a limitation to how much income I can make off a single client?
Oh, okay. That's interesting. Is there more to that, or is that the question?
That's the question.
That's the question. The answer is no. There is no limits that you can make on any particular client. But here's a potential issue, and maybe this is why you're asking it, which is when you have like just one client and that's all you do and you go to their office, you actually might be an employee of that company instead of an independent contractor. And it's actually more of an issue for that company than it is to you. That company, because they call you an independent contractor, they don't have to pay payroll taxes and benefits and things like that. You may actually be an employee, but that's a side point. The truth is, if you have a LLC, you could have one client, and as long as you're functioning as a separate company, independent contractor, and IRS has like 20 questions that they sort of go through to figure out whether you're an employee or independent contractor. It doesn't matter. You could have 100 clients, you could have one client, whatever.
I withdrew $8,000 from my 401k. I have retired at 59.
Okay.
I have not cashed the check.
Okay.
If I send it back, what happens? Will I still be penalized?
Well, 59. They're over 59 and a half.
Well, hold on. He said I retired at 59.
Oh, 59.
It came from your 401k. If you're separated from service at the age of 55, then there is no 10% penalty, first of all.
Right.
So if I separate from service from my employer and I take a distribution from my 401k, as long as I separate from service at 55 years of age or older, then there is no 10% penalty. It's not the 59 and a half, which is our IRAs.
Yes.
55 is the 401k. However, I can't separate from service at 54 and then when I turn 55 take the distribution. I have to separate from service from that employer active plan at age 55 in that given year.
In that given year to take that. And
take that 10% exemption off the table, or the 10% penalty to use that as an exemption.
Right.
So that's one thing.
Yes.
So, but I think the main question, I took $8,000.
Yeah.
I don't need it. Can I give it back?
Can I put it back? So yeah, then the question is does the 401k follow the IRA rules, the 60-day rule? I don't think it does, but what do you think?
No, I don't think it does either. 401k is under Section 401k, not under the individual retirement account.
So what we're talking about is when you have an IRA, you can take money out for any purpose, and as long as you put it back in within 60 days, there's no harm, no foul, no tax, and no penalty if you're younger than 59 and a half. But with a 401k, I don't believe that rule exists.
Because that's a distribution.
Yes.
They cut you a check. If you lost it, they'll cut you another check.
Yes.
Right? But it's out of the plan.
Right.
They're already sending the forms to the IRS.
Right. That's exactly right. So I think you're stuck on that one.
So if he's like, well, will I still be penalized? I mean, you wouldn't be penalized unless you didn't separate from service from that company at 55. Right, so let's say you separated from that company. It's an old 401k plan. Then that wouldn't work. Right, so I worked there when I was 40. I left, but I kept it in the 401k, and I worked at another place. But I'm assuming that's not the case. I'm assuming he's taking the money from his current plan.
Right.
That he retired at age 59. Maybe he didn't wait till 59 and a half.
Right.
Took the $8,000 and said, "Oops, I'm not 59 and a half.
Yes.
Can I give the money back to avoid that 10% penalty?"
Yeah. So he probably didn't know about the 401k 55-year-old
55 rule.
Mm-hmm,
right.
Which I think a lot of people don't know that. Now the other part of this is, do you have to pay income tax on that? The answer is absolutely. You always have to pay income tax out of your 401k or IRA.
Unless it was an after-tax contribution,
yes,
right?
Unless. There's always an unless, right?
Yeah.
But if you have a 401k and you retire and you've got some after-tax money in there, why don't you convert that directly to a Roth IRA? You're now allowed to do that, and then the pre-tax stuff can be rolled into an IRA if you want to, or left in your 401k, whatever. But yeah, that's a great way to get a Roth IRA without having to pay any tax.
Here's another question for you, Big Al.
Yeah.
How much capital gains tax will I pay on a home I sold after living in it for only 13 months?
Oh, I like that question. Because the rule is you have to live in the home 2 out of the last 5 years to qualify for the Section 121 exclusion, which is $250,000 or $500,000 if you're married. So if you lived in, what'd you say?
13
months. So that's below the 2 years. So now that falls under what's called a facts and circumstances test. And there are certain ways that you can get a partial exclusion. For example, and this says it right in the code, is if you...
What a facts and circumstances?
Facts and circumstances test. If, for example, Joe, you're...
So what we call Big Al.
Let's say you're married.
Okay.
And you...
Which I'm not.
But let's say you were.
Okay.
And let's say you're going to have a baby.
All right.
Okay, you bought your home. It's a 2-bedroom home. You're all excited. And in the hospital... Twins, right? 2 kids, unexpected circumstance. That actually qualifies for a partial exclusion. So the way that you do it is you take 13 months divided by 24 months, because that's 2 years. And so whatever that percentage, multiply it against the $250,000 exclusion per person.
About 50,
is what
55%.
Yes,
like
is what you would get. And so there's 2 of you, 55% of 500,000, whatever that is, close to 300,000, 280.
Right. So,
yeah.
I mean, if I've only lived there for 13 months, the likelihood of that increasing that much in value is probably pretty low.
So another one is if your home was found to have mold in it, right?
Okay.
So you didn't expect that. On the other hand,
how about if I get transferred?
If you get transferred, a job transfer, that could count.
Or maybe the company probably would pick that up.
Well, no, if there is a job transfer, I believe that's one of those. I don't have the sheet in front of me. But here's one that I know doesn't work, and that is people will say, well, I'm right next to a busy road, and I can't sleep at night. Well, you already knew that when you bought. So that's the idea. Unforeseen circumstances.
But if I don't have that circumstance, then it would just be a long-term capital gain.
You bet.
But if I sold it, let's say in 10 months, it'd be ordinary income on whatever gain that I had.
Yeah, in other words, if I owned it for 10 months, I didn't even own it a year. Is that what you're saying? Yes, it's a short-term capital gain, which is taxed at ordinary income rates.
But 13 months is over the 12-month threshold, so I'd be good there. So I'd pay 15% tax potentially, or it could be as high as 20. Or
yeah, but realize this: if you owned it 13 months, unless the home appreciated wildly, there's probably not much gain, because by the time you sell it, you have all these closing costs, and when you bought it, you probably put some money into it, and you had closing costs to buy. So there may not be much gain.
The most important investment that you folks can make, in my opinion, is an investment you make in yourself. And I want to give you all that opportunity right now, but this investment is not going to cost you a nickel, so very